again because it says we're live.
Mm-hmm.
Well, that's fascinating.
Just popped up.
Okay. Well, hello world. Normally, I have like 5 steps after pressing a certain button that takes us live, and now instead we're live right now. So, all right. Let me start the recording and we will jump on in. All right, good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner, and we have another very interesting topic for you today. We're going to be talking about some tax law changes. Super interesting, right? But this is how it may impact you and especially your retirement plans if you are planning to pass them on to your children or somebody who is not your spouse. So this might sound like a thing that you're interested in, or it might sound like, hey, that's not really important to me, but I would really encourage you to listen in because it could in fact impact your children in a tremendous way, and you can strategically mitigate problems by being really ahead of this topic and context and really understanding what it means. So some tax changes happened just a year ago that are impacting people starting now. So Bruce, let's go ahead and jump in to the Secure Act and what it in fact means, and specifically how it applies to retirement plans.
Yeah. Good morning. First of all, as always, we have a really good grasp of this information, but for your specifics, you really need to talk to your own tax professional, CPA, so on and so forth, because this is going to be specific. But we're going to talk about the takeaways in the Secure Act, and yes, some of it is about taxes, but some of it is also about trying to help individuals save for retirement. And there are some more lifetime income strategies for people that they can actually use some annuities now for this. So let's just talk about the takeaways, the key takeaways for this. Repeals the maximum age of traditional IRA contributions from 70 and a half to 72. So now, if you had to start taking required minimum distributions in 2020, so this went in effect January 1st, 2020. You can now delay those until 72. It does increase it does obviously increase the potential for additional tax for 2 reasons. The first is that your retirement account could grow, which everybody would say is a good thing, but it also then increases your tax liability. It also, what it does is it takes the possibility of paying taxes into the future much greater, and thus puts you at government risk of increasing taxes. So that's an important thing to consider. It also allows long-term part-time workers to participate in 401k plans. Previously, only full-time workers could do this. It
Yeah,
offers
Bruce, actually, I thought that was really interesting that it was kind of making retirement plans available to a wider range of people, which is, I mean, if you could really look at this and kind of say, well, the government says, hey, we need to help more people be able to plan for their future. We have Social Security not fully enough. We need to have this supplemental investment or savings by the individual. Not enough people are putting money into retirement plans. So how do we make them better? And we could say, is that really the ideal way to go to make retirement plans better? But really at the same time, we're looking at the government is saying, how can we figure out a way to improve this situation where 55% of adults are not putting money into 401ks and retirement plans? Maybe there's a good reason for that. But then also looking at the typical retirement plan has, I think, in the ballpark of like $58,000 in it for people who are 65 and over, which is just interesting, realizing that that's not enough. So this whole idea of having part-time workers now be able to contribute is the government's way of saying, well, hey, if that was your reason for not putting money into a 401k, now we're making it easier for you. If you're not full-time, you can even just be part-time. And there's some rules on that. It's like 1,000 hours a year or 500 for 3 years in a row, right?
Yes. And I think it's interesting when we start talking about this is that if if full-time workers previously were not putting a lot of money in, I'm not sure why all of a sudden part-time workers would start putting a lot of money in.
Sure. And that's you
I
and
mean,
I's perspective, right?
it's just human nature. But they did put they did put some tax breaks in it for the businesses. And one of the bigger tax breaks they put in is actually if you make it an automatic enrollment, then you get a bigger tax break. I actually have run into this with some employers, where their employees actually have to opt out of actually getting. They don't have to opt in; they actually have to opt out.
Yeah, I saw
And
something really interesting that they can automatically enroll you at a higher percentage too. So I think it was like 10% before, and now they can put you in at 15%. Anyway, so just really interesting things that are trying to get people to put more money away into retirement plans. And we're sitting here saying, our retirement plan is really the ideal place for you to be putting your money in the first place. But at the same time, there are some specific things that you need to know because maybe tax deferring is a good idea for you. And maybe it is something you really need to think about when you're crossing a tax deferral bridge between yourself and a next generation. That's really where this comes into play. But I'd love to hear you kind of share the rest of what we're looking at with this plan.
yeah, and so then just real quickly, there is some lifetime annuity strategies that you can now use in a retirement plan, which I think is good because there's always a fear of people running out of money. It
Mm-hmm.
also permits parents to withdraw $5,000 penalty free from the plans for birth and adoption expenses. And so, once again, I think I've mentioned this many times on the show that how many billions of dollars people have taken out of retirement plans prematurely and actually
Mm-hmm.
paid additional penalties. Maybe this will help alleviate part of that. And it allows parents to actually withdraw $10,000 from 529 plans to repay student loans. Now, some people might be saying, well, why are they getting student loans if they already have 529 plans?
Good question.
Well, actually, we could say that it is actually easier in a lot of cases just to go ahead and get the student loan. It may be at a lower rate, and you think your 529 plan can actually grow at a faster amount than the rate of the interest rate of the loan. So that you're kind of becoming your own bank in that situation.
Yeah, you're using arbitrage.
You use arbitrage. However, there's volatility involved, so on and so forth. Also, if one person in the family does not use their 529, you could actually use it to pay another one of the family members
Which
student loan.
that's a tremendous benefit.
Correct. And so there are reasons for that. So that's really, really good. But the big part of the Secure Act that everybody needs to know is the is now you can actually begin RMDs at age 72. I don't
Which
think
that's
this.
a change because it used to be you were required to start taking required minimum distributions at 70 and a half, right?
Right, and the government basically had a percentage of increase that you had to take out of uh, your tax deferred account every year until it was exhausted. Now they moved to 72. The reasoning for this is that they said that people are living longer, and so if they don't need the money earlier because they're actually continuing to work, then why penalize them for taking it out? You know. In an earlier time period. Let's let them delay so it lasts longer. Not a bad change, but
I would
also
agree.
you got to also think of though, are you delaying taxes that might increase in the future too?
And
So
then none of us know what taxes are going to do in the future. And I guess that is the number one question that really should be at the forefront of someone's mind as they're thinking about bless you, this whole idea of tax deferral in the first place. If I defer a tax, that means I'm not paying tax on this particular amount of my income today. And then I don't get a free pass. It's not that I'm never going to pay tax on that money. I'm going to just pay tax at some point in the future when I take the distributions out. And so that's why we even want to be concerned about this idea of when you take the money out, because it impacts not only your income, but potentially, very potentially, your taxes.
yeah, and so this is the meat part of the discussion today, and so let's just dive into this. So let's think about this. First of all, let's determine what is an inherited or beneficiary IRA or what is a spousal IRA. So if two people are actually married, they actually have a different rule than what we're talking about. So example, a spouse, in this case, let's say the woman has a tax deferred account, an IRA or 401k, and they are required to take minimum distributions at age 72, and they're taking them for 6, 8, 10 years. They die at, let's just say, age 80. Their spouse is also the same age 80. A spouse allows to inherit the tax deferred account and then take them RMDs over their lifetime, just like the previous spouse did. So spousal
Okay.
rules are different than what we're talking about today.
So you're saying with the spousal rule, you wouldn't have to increase the distributions or decrease them. You can just leave them the same and continue to receive the same amount of income.
Correct. There's one exception to this rule that I know of. If the spouse is more than 10 years younger than the deceased spouse, then that deceased spouse then has to turn it into an inherited IRA. And
Okay.
they have to then follow those particular rules. That's the way I understood the previous rule. And I'm sure that this rule is the same way. Once again, consult your current tax preparer, but I'm sure they kept that as the same. Now let's talk about an inherited IRA. In the previous rule, if you were to give it to somebody that was a beneficiary, normally it was somebody in your family, but it doesn't have to be. They would then have to start taking required minimum distributions right away, but they could stretch it over their lifetime. So let's say a 35-year-old inheritance from a 80-year-old, they would then take those RMDs every year beginning, and I see this all the time with my clients, is they'll have a small amount of inherited money coming out of a tax deferred account, even at age 35. And then at age 36, it's a little bit larger, hopefully, at age 37, so on and so forth. However, with the new rule, what they're going to say is a 35-year-old has to take out the entire amount over a 10-year period. Now, my understanding is they could take it out all right away. They could take it out incrementally, or they can wait to the very end and take it all out in 1 year.
As long as it's within that 10-year window.
As long as it's within 10-year window. And there is very big penalties, as much as 50% of what the required minimum distribution was. So you want to make sure you follow these rules. Now, let's just talk about the implications of this. So I tell people all the time that the American dream is that your children are better off than you are.
Mm-hmm.
So, and in fact, I find this not every time, but I find this a majority of the time. So the parents are good savers, and oftentimes they're good savers in a lower inflation environment, the last 40 years. And so they were able to save money and not have made as much money that they were taxed on during that 40-year period. A simpler way to say this is they may have only been averaging maybe $50,000 to $75,000 of income over that 50-year period, but they were able to save $1 million in a tax deferred position. Where their 35-year-old son or daughter is actually in the workforce, and because of inflation, might be making 100, 120, 150, 180,000, and if they're married, they might be making 200, 250,000. Now, this $1 million has to come out over a 10-year period. So now they have taxable income, let's say, of $200,000. They decide to take 1/10 of that out. Now they put it on top of the 200,000, and now they are stacking that taxable amount from 200,000 taxable, additional 100,000. Now they're being taxed at $300,000.
Which is a different tax bracket.
Potentially it's a different tax bracket. And the other thing is we don't even know what the tax brackets are going to be, because the tax brackets can be changed through Congress at any time. Not
Mhm.
only the percentage they take out, but the width of the brackets, how long you will stay in that particular bracket. So
Yes, and
potential,
I like to think of that as a tax threshold. So the amount of money that it requires you to make in order to bump into the next tax bracket. So what you're saying, those width of those brackets, that just means the change of the threshold. So it's possible that the threshold or the width of the bracket might be $100,000 of a width right now, and it could shrink so that you have less required to bump up into the next tax bracket. And that's the really interesting thing about taxes as a whole. I mean, we don't know what future tax rates will be. We don't know what the thresholds for each bracket will be. We don't know how many brackets there will be. There's no guarantee that we'll have the same tax landscape in the future for our kids that we have today.
correct. And taxable income, like right now, from 168,000 to approximately 321,000, you are actually in the same tax bracket, the
Oh,
24
interesting.
the
Okay.
24% tax bracket. Now, this is very different because of the Tax and Jobs Act of 2017. However, if you're down in the 22% tax bracket, that only goes from 78,000 to 168 approximately. And so you're only at 90,000. So now if you're pushing close to the 150, you were actually pushed up into the 24% tax bracket, and that one is going to cost you a minimum of 2% more taxes on your income. If you're down, now here's the real big one. Let's say you are just starting out. Maybe you're not making that much. Maybe you have 4 children. Maybe you have a lot of tax exemptions, so on and so forth. Maybe you own a business, and so you don't show a lot of income, and you're down in the 12% tax bracket, but you're making about 75,000 taxable income. And now you have to stack $100,000 on top of that 75,000. It goes from 12% to 22%. So you're
Mm,
paying 10% additional taxes on that income. That is a big jump. There are also other,
absolutely. And
yeah,
I think it is really helpful when we understand, as you're talking about, the whole picture. Because if you just think today, my one objective is to store up as much money in this account as possible because I'm deferring tax, which means the amount that I put in my contributions into the tax deferred plan each year, that comes off of my taxable income. So it lowers my taxable income this year, potentially bumping me down into a lower tax bracket. Maybe, maybe not. I know you're going to talk about this in a second. But if we just think about today only, and we only think about our own life, and we don't step back and look at the big picture, we can miss the implications that can be happening for the people who will be receiving the distributions if we don't live as long as we're planning to, or if we end up using up our other assets and using our retirement plan as our legacy. So I think it's really helpful to step into two shoes. One, the shoes of you as you're putting away the money today, and two, the shoes of you if you are receiving money from somebody else who was tax deferring.
absolutely. I actually have a client that has 2 daughters who are doctors. One of them's married to a doctor and another one is married to a very successful person. They are paying the max in taxes of
Mm.
37% and an additional about 8% state taxes. So now in retirement, this particular client has about $2.4 million in tax deferred, but they only live on $80,000 a year. They're very frugal, which I find a lot of times in the baby boomer generation that is true. So we started talking about tax strategies now. Should we maybe actually have him take out more to pay at his lower tax rate, even though he doesn't need the money, so that he's paying it at a lower tax rate, so that he can pass it on what's left in a more favorable tax situation, whether it be a brokerage account, whether it be in our case, we're looking at a tax, a specially designed insurance policy, so it would grow tax free, or whether it's just put it in your mattress or a money market account, because he
Mm-hmm.
knows he's going to pay at the most 22%. But if he passes it to his children, they're going to pay 37 plus 8% of state taxes. So these are the kind of strategies that we talk about with parents that say, hey, maybe you shouldn't just mindlessly pass the IRA as your legacy, and maybe do some active tax planning. This is what I always call it, active tax planning instead of passive tax planning. It doesn't happen in everything, but you should. Here's one last thing I'd like to talk about, the implications. And this is one, Rachel, that people do not think about. As we start to live longer and longer, we now have people that are in their 90s that have children that are really close to actually be in required minimum distribution age, because they would have had them, society had children at a younger age back then. So if they're at like 92, they had them at 18, you can see where they would be 74 now. Or even if at 20, they would be 72. Well, there's something called means testing in Social Security and Medicare, so that if you actually make more money, you have to actually pay more for your Medicare Part B and Part D payments. And this is substantial. So I'm just going to give some examples. So let's say somebody is paying right now it's about $144 a month for their Part D. And I'm sorry, Part B. We don't have time to go into this. Maybe this is a good topic for later on. We'll start talking about Medicare payments, but Part D is varied. If they go up $100,000 from that, they suddenly change their Medicare payments, if they're single, from 144 to well over $350 a month.
And so that's for Part B.
That's for Part B only. That's for Part B only. Part D will also be impacted, but I can't really tell you because it's more of a sliding scale on that situation. But so that's another huge impact that a person could have by having an inherited IRA that they have to now take out over a 10-year period. And that is that impacts people's cash flow. Now, I know what some people are saying, well, yeah, they got to pay another $2,500 or $2,500 and maybe $3,000 more for their Medicare Part B, Part D, but they just received $100,000, from the inherited IRA. Yeah, that's true. I'm not saying that they're going to be have difficult cash flow. What I'm saying is, without active tax planning, it's another $3,000 that could be going out the window. Now think about
and it's just whittling away something that you were planning to pass on a certain amount. And no matter if it's $100 lost or $50 lost, really what you don't want is you don't want to think you're transferring. I know we talked about it's not a gift. You don't want to think I'm transferring this legacy of this amount of money, and all of a sudden all of these things are taking their cut of it, and it's not anything like what you intended.
Right. And think about this. It's if it increases your Part B and Part D by as much as 3,000, and it can actually increase it by more than that. That was just my example. On $100,000 of an RMD, that means you've lost 3% of the RMD.
Yes.
So now if you put it into a growth compound, or where you're trying to compound the growth, you're down 3% every year from that growth.
Which, as we know, you cannot lose 3%, gain 3% to be back at zero. You now have to gain more than what you lost just to recover. So that means you're having to work extra hard to keep everything up. I mean, honestly, it's like a mobile. Everything is related to everything else and balances everything else out. And if you only look at one factor, you're going to miss the landscape and realize that you could have done so much better.
Yeah, and this is the final thing that I'd like to finish with this today. For every dollar that you can save legally in taxes, it's another dollar that you can save, invest, or give away. When you invest it, you actually, when you save that particular dollar, that's another dollar that you are actually gaining in your control without taking any risk. So that is an important thing for risk adverse people.
Oh, yes. Sorry, I didn't mean to cut you off. I thought you were going to go on to the save, invest, or give away as well.
Well,
So
no, I'm just saying that it's really a mindset for people. It's funny. I've used this analogy a lot of times. People are and I know you remember this because you've talked about this. People will drive down the road. There'll be a median in the road. They'll see gasoline on this side for $3.
oh yeah.
They'll see gasoline over here for $2.90. They will drive to the stoplight. They will make a U-turn. They'll pull in. They'll put 10 gallons in. They save $1. But yet they won't take the time to actually do an active tax plan, where in this case we just gave could save them potentially $3,000 a year for 10 years.
Well, and I think the interesting thing about this whole thing is that you can maximize your money. You can optimize the way that you are using a functional money system in your life. And that will improve not only your life today, but your kids' life in the future. That will allow you to spend more, save more, invest more, build time and money freedom more effectively, and live a happier life. And so that's ultimately our goal here, is to empower you with education and knowledge that really helps you take control and allows you to enjoy life more fully. So that's what we have hopefully done today. I don't see any specific questions, but I also was not watching the chat correctly today. So I'll try to make sure that I do that next time. Thank you guys so much for watching and being with us today. If you are interested in finding out more, we do want to let you know that we've mentioned today specially designed whole life insurance. If that's something you've heard us talk about before, or you just might have heard a little key about that today, that it's tax free. It's actually tax deferred growth, but you almost never end up paying tax on that growth through interest and dividends. If you're interested in learning more, we do have a free guide that you can get. It's called the Quick and Easy Privatized Banking Guide for Investors. It shows you how to accelerate time and money freedom, boost investment returns, and not take on additional risk. It's a fantastic strategy for a lot of people. We also have a course on the same thing if you're interested in digging deeper, or you can book an appointment directly with us and our team at themoneyadvantage.com. And we have access to our calendar right there, and you can book an appointment and really figure out how to strategically maximize your money that you have today so that you can make the most of it. We're not about making just more money or having a flashy return or being in a position where you have the biggest nest egg. However, we are in a position of saying, how do you take the income that you make, keep as much of it as possible, protect it, and use it to make more so that you can build time and money freedom. So with that being said, thank you so much for joining us today. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love.